Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to go over a practice problem in Excel related to tax allocation in Consolidated Balance Sheet. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to enter that information into the blue area on our right-hand side where we have the worksheets that we will be working with, our journal entries, and then our consolidation worksheet to the right. Let's see what our information says. We have the tax allocation in Consolidated Balance Sheet. So we got a tax allocation that's going to be kind of like the new component that we will be dealing with at this time. So P purchased a percentage of S common stock on December 31st, 2000 X5 at book value. P is going to be the parent, S the subsidiary. Purchase 70%. Fair value non-controlling interest, therefore then 30%. December 31st, 2000 X7, P or parent has inventory purchased from S for 74,000. So we've got this inventory that's going to be intercompany or between P and S, parent and subsidiary. The cost to S was 54,000. So let's go through that one more time. On December 31st, 2000 X7, P has inventory purchased from S for. So 2000 X7 is going to be the year that we're going to be consolidating for. That means that in ending inventory on P's books, we have inventory that was from a sale from S. So, and it's on the books for 74,000, which is what P purchased it for. And so the cost to S originally was the 54,000. And then we have S purchase inventory from P, and S ending inventory included amount from P, which is 89,000. So now we've got S inventory from P. In other words, P sold inventory to S, downstream sale transaction, and then S still has some of that inventory in the ending inventory as well for 89,000, and the original cost to P before selling it was the 64,000. December 30th, 2000 X7, S sold machinery to P for, so the subsidiary then sold machinery, depreciable assets, to the parent for 98,000, purchased it for 128,000, book value at 53,000. And then companies file separate tax returns and are subject to tax rate 40%. P does not record tax expense on its share of S undistributed earnings. Okay, so now let's go through our tables here. So now let's go ahead and hide some cells so we can see our worksheets here that are going to be next to our data, basically our trial balances. So I'm going to highlight from J here, from J to Q, from JQ, and then let go or select that area. Right click on the selected area and hide it. So there we have it. Now we've got our P. This is going to be for the parent. This is the subsidiary as of the point in time that we're going to be doing the consolidation. So let's first think about the allocation of the equity, or think about the equity allocation in terms of let's pick up the full equity first. We'll take the common stocks. I'm just going to say negative of the common stock of S here, and then we're going to take the retained earnings, negative of the retained earnings. That's going to be totaling up to the sum of those two items, the 416. That, of course, also equals assets minus liabilities. That's the 416. That's basically the book value as of the end of the year, which is the time period that we will be consolidating for. Now, of course, P, using the equity method, is reflecting their investment in S on this 248.9. Notice this is just the balance sheet, so we're not going to be dealing with the income statement right now. Anything that's going to be dealing with the income statement in terms of our journal entries, we will be posting basically to the retained earnings here. So then let's consider this in terms of the breakout between the non-controlling and controlling interests. So if we take this same 416,000, the controlling interest is going to be the 416 times the 70%. Non-controlling interest is going to be that 416 times the 30%. So there's going to be our breakout in terms of the non-controlling interest and the controlling interest. So now we have the adjustments to the basic consolidation entry. So we're going to have our basic entry, our first consolidation entry. Then we'll have adjustments for them. So let's pick up the book value. Let's say the ending book value we will pick up. and that's going to be that same 416. Pick up that 416, which normally the first journal entry, we're going to break that out between the controlling, non-controlling interest, the 416 times the 70%, and the 416 times the 30%. Okay, and now we want to think about these transactions over here and what the effect will be with regards to that first entry. To do that, let's go ahead and unhide some cells. I'm going to go up to H, or column H to V. So we're going to go to column H to V, right click and unhide. So we'll unhide those cells. And then we'll consider these transactions on the right. Let's consider this one first. So I'm going to take a look at this one. Let's highlight that with a green here. Now, we're not going to spend a whole lot of time on this. If you want to go back to the effects of these intercompany transactions before the tax effect and look in that to more detail, you can look at prior presentations. At this point, our concentration is on the tax effect of it. So we have the S purchase inventory from P, and S ending inventory includes amount from P of this amount. So S purchased the inventory. That means P sold it to S. That means it's going to be a downstream transaction. So this is going to be a downstream transaction that we are considering. We're talking about the ending inventory. So what is still on the books in the ending inventory, they're saying, is the 89,000. So I'm going to put in here the cost to S. The cost to S that's included in ending inventory is this 89,000, and then the cost to P, or the original cost, is going to be this 64,000. The 64,000, and then the difference is going to be 89 minus the 64, or the 25,000. And this, you can think of this as basically the gross, let's say gross profit that is included in basically the ending inventory. So then we're going to say, okay, the tax we said was the 40%. So I'm going to take that 25,000 times the 40%. And so that's going to be the 10,000. And then I'm going to take the gross profit minus the 10,000. And that's going to give us our 15,000. Now let's consider, I'm going to make this one, let's say we make it yellow because it's done. And let's go to this one now and make it green because that's the one we're working on. So that one says December 31st, 2000 X7, P has inventory purchased from S. So P has inventory purchased from S, so sell from S to P. So that's going to be an upstream transaction. We'll do a similar process here. It's going to be the cost to P now, because this is going to be upstream. And we have P has inventory on the books at the amount that they purchased it for, which is going to be the 74,000. I'll call this original cost this time. And this is going to be the 54,000. And this will be the gross profit. And that's going to be equal to the 74 minus the 54. 20,000, and then we'll do the same tax thing. It's going to be the 20,000 times the tax rate, which is going to be that 40%. And then if we then subtract this out, we got the 20,000 minus the 8,000 gives us that 12,000. So when considering our adjustments to the original journal entry, we'll take these into consideration. I'm going to be taking the item here. I'm going to call this the gross profit deferral net of tax up. So this is going to be the up one, the upstream one. So I'm going to be picking up then, and I'm going to say negative of, that's 12,000. I'm going to be breaking that out then between the P and the non-controlling interest using the percentages of 70-30. Again, if you want more detail on these inventory transactions, you can look at a prior presentations on it. The new thing we're considering here, of course, is this. Now we have this tax effect that we're considering in on it. So we have the 12,000 times the 70%. And then we're going to say this is going to be the 12,000 times the 30%. So there we have that. And then the next one we're going to be picking up then will be this item. And that's going to be the 15,000 for the gross profit deferral net of taxes down. So downstream transaction. 15,000, because this is downstream, it's just going to be going to P, the parent company. So there we have that. And then I'm going to go to the gain on the machinery down here. So let's go ahead and make that one yellow. And then we're going to go down here and we're going to say, all right, now we got this sale of the machinery. Let's make that one green because that's the one we are on at this time. And then we work on the green one. That's the one we work on. All right, so then we're going to say that, let's break this sale down. We'll say sales price was, I'll put this in the outer column. We sold this thing, or this thing was sold, intercompany sale, in the year that we are consolidated, in 2000X7, S sold machinery 2P. So company transaction that we're going to have to eliminate in the consolidation entry. So the purchase price was this 128,000. I'm putting this on the inside now, and the note that we should be naming this the accumulated depreciation. So I'm going to have cost here, but no, I will change it at a later point. But accumulated depreciation. So we got the purchase price less the accumulated depreciation. That's going to give us the book value. Cost, I'll actually back into because they gave us the book value. So the book value is going to be equal to this 53,000. Therefore, the cost must be the 128 minus the 53, so that we have then, just to double check here, the 128 minus the 75 should be the book value of that 53. Okay, and then we're going to say that we can get the gain then. There's a gain, and that's going to be equal to the 89 or the 98,000 minus the 53,000. So there's our gain, and then we have the tax effect on it. The tax effect is going to be that 40% once again. So the 45,000 gain, we're going to be picking up the rate of the 40% tax effect, and that'll give us the gain after taxes, which is going to be the 45,000 minus the 18,000 or the 27,000. So then we're going to be picking that up over here. We're going to call that the upstream gain on asset sale net of the taxes. We're going to say negative of that 27,000. We'll pick that up in terms of the 70/30. So it's going to be the 27,000 times the 70%. And then we'll pick up that 27,000 times the 30%. And that'll give us our totals down below, total. And I'm going to be summing this up. We're going to sum up these items. I'll sum up each row individually just to emphasize the summing process. So we'll sum each of those up. All right, and so there we have that. And these two should add up, just for a double check, to that 362 as well. So then we're going to have the deferred gain calculation. I'm just going to be picking up the same information that we put in this table up here, down below, but just taking basically the heart of it in here, the middle component, the middle piece. So I'm going to say, all right, let's just copy these. I'll bring these down here. Or even let's do it with a formula, because if you work on the Excel sheet without me babbling over here, it might be easier to see. So I'll pull these over with a formulae. And then we'll pull these over with a formula. I'm just going to be pulling in the same data, and then same data, and then same data, and one more time, same data. Then let's double check our totals, just summing them up this way, summing them up like this. And then I'll copy that and paste it on down here. So we got those. Let's go ahead and underline, home tab, font, underline this one. Then we'll sum these up individually, summing them up individually. What happened? And then tab, sum, and then tab, and then sum. All right, so there we have that. So now these totals basically match those totals. We just mirrored these out, and we come out to our totals down here for the deferred gain calculation. We're going to be using these for our consolidation entries. So now let's move on over to the consolidation entries at this time. So we'll move on over to the right, and we have then, now note we have two sets of debits and credits. I'm going to go ahead and hide this one to the right We don't really need it. I don't think we're going to need it at all, but I don't want to delete it because I don't want it to mess up the sheet that you are currently working at. So I'm going to highlight these or select them, right click, and we will hide them. So we're probably going to permanently hide those. I don't think we're going to need them. All right, then we're going to do our adjusting entry. So we're going to do our adjusting entry. Now remember that there are no income statement accounts. We're just looking at the balance sheet accounts for our trial balances here. And we're still going to do basically the transactions to the income statement, but I'm just going to post them into retained earnings directly. So we'll just kind of simplify this process so we can kind of concentrate in on the new component, which is going to be the deferred tax asset that we have here. Okay, and so that might make it a little bit cleaner to look at. But in any case, we've got the trial balance. This is basically a post-closing trial balance for P, post-closing for S, the parent, the subsidiary, as of the point in time that we will be doing the consolidation. We're going to sum this up, equals the sum of, and we will sum these two. So there we have that. I'm going to close that up and then copy. So we'll copy that and paste it on down. Copy and paste that on. Whoop, I copied again. Copy and then paste. Copy and then paste. All right. So then we're going to have the investment in S. So there's the investment in S. Then I'm going to be picking up the common stock and the retained earnings. So I'm going to pick up the common stock and the retained earnings. So we'll pick those up, and we're going to be removing those, basically those beginning, balances that we have in there. So I'm going to say, all right, common stock has a credit in it, so we're going to debit those. Standard process. Retained earnings has a credit in it, so we're going to debit it to remove it. Then we have income from S. Income from S. Now, that's not on the income statement here because we're basically just looking at the balance sheet accounts. We're going to be pulling this from our table, however. So we'll pull this from the table to the right, and that's going to be P's calculation that we calculated down here. So I'm going to say this is going to be then, I'm going to say this is negative of, I'm sorry, not negative of, it's just going to say equal, it's already negative down there. That's 42.3. Then we have the non-controlling interest in I of S, which once again would be basically on the income statement. So we don't see it on the trial balance here, but we're just going to pull that from our table as well. We're going to pull that then, that's going to be the 11,700. The 11,700, so this is going to be equal to then that 11,700, the 11,700. Then we have the investment in S and the non-controlling interest in NA. So the non-controlling interest is going to be here. So now you could see that if we were to add these up, if I was to sum that up, that's going to be the 362, which is our adjusted amount here, right? Because the beginning amount was the 416. The 416 being the balance sheet accounts or the assets minus the liabilities or the equity section. 416, which we have now adjusted to be this 362, and that's going to equal this 362, which we're now breaking out from the parent to subsidiary, the 70-30%. So we'll just pick these up from this table. So that means the non-controlling interest then is going to be the 1131, and the controlling interest we'll put up top, and it should be a negative for the credit here, so I'll make that a negative sign in front of it. And then for the investment in S up top, we're going to be picking up the 248,900, the 248,900. Let's see if that adds up to 0 like it should. It does indeed, so let's go ahead and post that out. So back on over to the right. We've got the investment in S up top. So we got the investment in S. We are in Z9. This is going to be equal to that 248.9. That brings it to 0. Then we've got the common stock. So common stock down below was going to be here. We're going to be in Z14 equals the 141. That's going to bring it basically back to the parent portion. So we got the parent, subsidiary, total, then the subsidiary removed back to the parent. Then we're going to the retained earnings. So retained earnings is going to be equal to that 275,000. So once again, we've got the parent subsidiary total. We would remove the subsidiary back into the parent. So then we have the income from S. That would be on the income statement, which would roll into retained earnings. So since we're just looking at the balance sheet now, I'm going to post that to the retained earnings. So anything to the income statement, I'm going to post here the retained earnings. That's going to be the 42.3. Same with this non-controlling interest in the net income. That would be on the income statement. I'm going to post it to retained earnings here. I'm going to double click on this, say plus. We're going to pick up that 11.7. 11.7. And then we've got the non-controlling interest in A, which is going to be down here. And we'll pick that up. This is going to be equal to the 113,100, the 113,100. Okay, so now we're going to be considering this transaction and reversing the revenue and cost of goods sold basically related to it, and then thinking about the deferred tax assets and deferred tax expense related to it. So this has the revenue. It's going to be the revenue of the $74,000 that we're going to have to be reversing. So we're going to say revenue needs to go down because this was a sale from one to the other. So it's still on the ending books. It's still on the ending books at the $89,000. That was the sales price. So sales is overstated by that 89. That's going to go, we're going to put that into the retained earnings, but let's call it revenue. Any income statement account we're going to post to the retained earnings, however. So I'm going to put that as a debit, and so we're going to be debiting the revenue, which would be decreasing the revenue. Then we have the cost of goods sold, so cost of goods sold, and that's going to be a credit, which would be reducing it by that $64,000, and then we're going to have the inventory, which is going to be an asset account for the negative sum or the plug, which will also be, of course, that $25,000. So we'll post that out, but first let's take a look at the new thing, which is kind of like, which is the tax impact of this, which means we're going to have the deferred tax asset. So we're going to have a deferred tax asset, and then we're going to have a deferred tax expense, and that's going to be for the that's going to be for the 10,000. The 10,000. So that's going to be the new component here. So let's post that out. We're going to have the revenue up top. So the revenue is going to go to the retained earnings because we're on the balance sheet side of things. So will the cost of goods sold. Inventory will go up top. So let's go to the retained earnings. I'm going to double click on it, go to the end of it. I'm going to say plus. We're going to pick up the revenue, and I'm going to say plus. I'm going to pick up the cost of goods sold, which is basically going to all close out into the revenue for our balance sheet. And then the inventory is going to go up top in the inventory up here. So I'll pick up the inventory then of the 25,000. Then we're going to pick up the deferred tax asset. So that's going to be here on the assets side of things, deferred tax asset of the 10,000. And then once again, the expense account is going to be rolling into that retained earnings. Therefore, I'm going to double click on the retained earnings again, go to the end of it, plus we're going to pick up then that 10,000. So we'll do a similar process for this one. This is the current upstream transaction. So we're going to say we're going to remove the revenue again. So I'm going to pick up the similar transaction, revenue, cost of goods sold, inventory, and that's going to be the revenue. I'm going to be picking up a debit to reverse or decrease the revenue for the 74,000. Cost of goods sold is going to go down with a credit of the 54,000, and then the difference, I'm going to say negative sum plug formula, or you could pick up that 20,000 here. Then we'll have a similar process with the deferred tax assets and the deferred tax expense. That's going to be for the 8,000. So we got the 8,000 and the 8,000. Okay, so let's go ahead and post this out. So now we have the revenue. So here's the revenue and the cost of goods sold, both going to be income statement accounts. So we're going to post them both then to the retained earnings once again. Double click in the retained earnings, go into the end of it. I'm going to say plus. We're going to pick up that revenue of the 74,000 plus, and then I'm picking up the cost of goods sold at the 54,000. Next items go into inventory up top. So I'm going to go into the inventory, double click on it, go to the end of it and say plus. We're going to pick up that 20,000 up in that section. Then we've got the deferred tax assets. Deferred tax assets going to go into the deferred tax asset account here, plus the 8,000. And then the deferred tax expense is going to be another item on the income statement, which will roll into the retained earnings. So I'm going to double click the retained earnings, go to the end of it, say plus, pick up the 8,000 there. Now we'll do a similar process for the sale of the machinery and the equipment, or the machinery, where we had a gain of that 27,000. So we're gonna have to deal with the gain of the 27,000, or the gain of the 45,000. The gain after taxes was the 27,000. So we're gonna have to put the gain back on the books. I'm just gonna call it a gain, and that's going to be, I'll be picking up then. The gain would be a credit. So we're going to reverse it with a debit. And again, you can get into more detail. We've spent more time on these transactions for the sale of depreciable assets in prior presentations. Our main thing here is to do that new deferral that's going to be the tax impact, which will be this 18,000 here. So then we got the accumulated depreciation, which we're going to have to put basically back on the books, right? Because we decreased the accumulated depreciation during the sale. The accumulated depreciation would have gone down, and it shouldn't have. So we got to make it go back up with a credit. So we're going to credit the accumulated depreciation, and then the machinery is actually on the books for the company that purchased it at the net, cost price that they paid for it. And what it needs to be on the books for is the original cost. So we actually have to increase it, and that's going to be for it's on the books. It should be on the books for the 128, and it's going to be on the books for the net sales price, which is the 98,000. So the new company that put it on the books for the 98, but the original cost is the 128, and the related depreciation is going to be the 75. So I'm going to say enter. Okay, and that's going to give us our 30,000. And note, this should better be called accumulated depreciation. I'm going to change that now. Then we'll have the similar tax calculation or similar tax effect, which with the deferred tax asset and the deferred tax expense, and that's going to be for that 18. So the 18,000 on the debit and credit sides. Okay, so let's go ahead and post that out. So we're going to have a gain. That gain would be on the income statement. Therefore, I'm going to post it here to the retained earnings. Double clicking on the retained earnings, going to the end of it, saying plus, picking up that 45,000. Then we got the accumulated depreciation. Here is the accumulated depreciation. We're going to be in Z8 equals, scrolling down, picking up that 75,000. Then we have the machinery. The machinery is going to be up top. Here's the machinery. We are in Z7. I'm going to say equals and pick up that 30,000. Then we got the deferred tax assets. So the deferred tax asset is going to be up top. Here it is. I'm going to double click on it. Go to the end of it, say plus. We're going to pick up the 18. Happens to have 18 in it already, but that was the coincidence of the 10 and the 8 here. And then we got the deferred expense. Tax expense, which is going to be a income statement account, which we will then put into retained earnings. Double clicking on the retained earnings, going to the end of it and say plus, and we'll pick up that 18,000, and that should put us back in balance. We've got our equity section here, the common stock reflecting the parent's common stock. The retained earnings doesn't reflect that because this is the ending retained earnings, so we've rolled out the income statement information into it. And then we have the investment account down to 0 here, and we have our items for the deferred tax assets.